Good morning. That's not a great way to start, is it? Sorry about that. Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 15th of October, and we have Brent crude oil trading significantly lower this morning, down in Asian trade close to 4%, now below $75 a barrel and falling. Let's kick off this morning with Clyde Russell, who has given us a very interesting report this morning from Reuters. Of course, Clyde is Asia and commodities energy columnist for Thomson Reuters, and he has put a pretty comprehensive overview of the supply-demand balance given the OPEC report yesterday. Clyde, just give us your headlines and takeaways of why you think it's relevant for the market.
Well, I think, first off, the fall in crude today is just really an Israel not going to be attacking Iranian oil thing. But that comes against the backdrop of a much more sort of comprehensive demand problem. And what I was really writing about today was looking at China's demand and OPEC's forecasts. Now, OPEC has trimmed its forecast for China's oil demand growth in 2024 to 580,000 barrels a day. That's down from a peak of 760,000 barrels a day that they were saying was going to grow back in July. So they are cutting it. But it's still completely out of whack with the reality of what's actually going on in China. Over the first 9 months of the year, Chinese imports were about just a smidge under 11 million barrels a day. That's 350,000 barrels a day less than what they were in the first 9 months of 2023. So you've still got OPEC on the one hand saying, we expect China to increase its oil demand by more than 500,000 barrels a day. But in reality, their imports are down by 350,000 barrels a day. Yes, it had a little bit of an uptick in domestic production, but nowhere near enough to offset that massive fall in imports. So, I still think OPEC is overly optimistic. They're still way too bullish. Their forecasts, while moving in the right direction, just aren't reflective of reality. So if you're looking at crude, I think the relevant question is how much of a premium is still built in because of the potential conflict in the Middle East hitting or expanding to hit oil production or export facilities. That's, for me, the key. Because, I think you're seeing a little bit of that coming out now if the Israelis can be convinced not to attack Iranian facilities. But you've still got quite a large premium built in there. And, if that premium wasn't there, where would oil be? And if you were certainly looking at Asia and more specifically China, it would have to be a lot weaker than what it currently is.
Well, let's give that easy question to none other than Adi Imsirovic, Director, Surrey Clean Energy and Senior Associate at CSIS. Adi, we've seen the geopolitical premium balloon deflate before today, yesterday, and it's been since the high water mark briefly above $80 last week. Where do you think this deflation ends?
Well, that's a great question. First of all, the geopolitical premium was not particularly large. $5 a barrel is not very much when you see the extent of the war in the Middle East and potential for it to spread. Obviously, there's no oil in Palestine or Lebanon, but the key was Iran. It seems that all the parties are concerned about escalation with Iran, direct escalation of this war with Iran. As Clive mentioned, I think that sort of the market is at least discounting that. Now, going again to where the price may go, everyone is looking at the balances. I will not repeat much what Clive said. I can only say one thing, which I think is really, really important. OPEC Secretariat has some amazing people, excellent analysts, but I don't bother reading their reports anymore. They're basically a top-down propaganda rather than serious reports. Not that I'm sort of huge supporter of international energy agencies, but they're very much in line with everyone else. EIA are very much in line with the International Energy Agency as well, and most other reports from banks and various other analysts as well. So we're talking about an increase of about 1 million barrels this year, and not more, if that as well. China being a big problem. And I think there was fantastic piece yesterday in Financial Times talking about China surprising pretty much everyone with heavy-duty vehicles. About 40% of all the new heavy-duty vehicles being sold in China are now powered by LNG. And in fact, Daimler-Benz and similar companies are struggling in China because nobody wants to buy it. I put on Twitter a graph where, basically per MMBTU, LNG is about 30% cheaper than diesel. So on top of that, also the government encourages it because it results in cleaner air. If this continues, already we're replacing almost 300,000 barrels a day of diesel. And also I read somewhere yesterday, very interesting fact that according to some, the diesel demand in China might have peaked back in 2018. Certainly this year, it's down by about 4%. And if you think that diesel is about up to a quarter of all the, if not more, of all the oil demand in China, that's huge. 4% fall. So the bottom line, Sean, is that I think we all have to realize that this decade oil demand is peaking. And the sooner we realize that, the sort of bigger picture will emerge. And already you can see it in the Brent market, where dated Brent is barely positive in terms of backwardation. In terms of Brent spreads, they're all below 30 cents a barrel. In fact, next year they're in their teens. So we're barely in backwardation next year. So that tells you everything that you want to know about the market.
Osama Rizvi, energy and economic analyst, Primary Vision Network. Although Adi has just said that we know everything we already know, so we should stop this podcast right now. So you don't get to have your say, but I want you to have your say. So your say, are we returning to the $70 barrel sort of point that we were sort of stuck at before this recent elevation in the geopolitical risk premium, that we're going to test $70 Brent again, and that's where we were, and that's where we're going back to? Your thoughts on that?
Well, just as Clyde said, I think the main question, the main issue boils down to whether Israel is going to attack Iran's key oil facilities and infrastructure or not. Plus, how are the investors
They've said
going to look
how
at...
generous of them they're considering not to do it.
Yeah.
They're busy slaughtering innocent people living in tents. Yeah. They can't waste bombs on oil infrastructure.
That's a shame what they're doing. But coming back to the question, I believe, I look at the oil prices and the oil demand as compared to the global economy. And if you look at the global economy, you look at Eurozone, you look at Germany, the energy intensive industries, manufacturing and production has basically flatlined. You look at China, Chinese fiscal stimulus has drawn out a little bit of home buyers and home viewings. They were up about 23% during the National Day holiday period, but still, overall, they have disappointed so far. You look at the US, which is a very interesting case, giving conflicting, confusing signals. But I've been following the consumer side really closely, and we are seeing that savings are falling. Spending might peak very soon. Credit card debt is already at record levels. Delinquencies are high. And many of the people surveyed cannot afford a surprise spending of about $800 to $1,000 a month. Moving forward, IMF has recently warned about rising global debt levels. We don't know that what options does the Fed have after the 50 basis point cut. So when I look at all of these factors, I still see more downside for oil without any further escalation in the geopolitical risk. So for me, moving forward, I believe the chances for oil to enter 70s or potentially, possibly, fingers crossed, if there is a de-escalation and things come to normal, maybe entering the higher 60s. That is a bigger possibility than going up to 85. It can happen temporarily after a strike, but it'll come down.
Clyde, returning to your reporting this morning in your article, if I read it correctly, you said that the Chinese built inventories by over 1 million barrels a day through the first 3 quarters. Is that correct? That seems like a massive stock build.
Well, it's not quite as precise as that. That's what I refer to that is their surplus oil. So this is just a simple calculation of looking at the total amount of crude that they have from imports and domestic production, and then the reported refinery runs and looking at the gap between them. So on that basis, they had 1.1 million barrels a day more available than what they refined. There is some sort of questions. I don't really question the import accuracy or the domestic oil output accuracy. I think those are quite good statistics that can be verified. But the refinery throughput is a little bit trickier because we're not sure it's capturing absolutely everything. But overall, it's quite clear that they've imported or they've taken a lot more oil than they've actually processed. Well, we can argue a little bit about the numbers, but the trend is fairly clear. And that's been something that's actually been accelerating. So they've been adding more and more potentially into their storages. I don't think it probably actually is the whole 1.1 million barrels a day. That's just a surplus based upon the official available statistics. So, but I mean, what you have is it's quite clear that what the Chinese have actually been doing is when they see prices fall, they tend to buy. And if you actually look, Chinese imports have, with a 3-month lag to the Brent price, are actually, there's quite a strong correlation. Brent falls, the imports go up. Brent rises, the imports start to ease off once you adjust for that lag between when they actually buy cargoes and when they physically arrive in China. So what we actually saw is that, you had a fairly weak September, but the oil that was arrived in September was bought while Brent was going up in price, which was like June into July. Since then, you've actually seen Brent come off a little bit, notwithstanding the bump that we had with the latest sort of worries about the conflict in the Middle East. But you had a sort of declining trend from July. So I would expect that you might actually see Chinese imports post some sort of recovery in October and November. But I mean, you got to remember that this is just a price-driven thing. When they see prices are softer, then they tend to buy more, and that's kind of how they go. And I think what they really would be interested, there would probably be a certain level of nervousness amongst the Chinese refiners that they want to have quite a lot of oil built in stockpiles just in case the Middle East does erupt into something much more serious, and then they just dip into their inventories and they trim their imports quite dramatically. So, that's kind of how they've been operating the last couple of years. And I expect that pattern to continue. But it does mean that when oil prices rise, China basically acts as a stabilizer by importing less. But conversely, when oil prices fall, then they tend to buy more.
Adi, when we asked our survey question yesterday, we had put into the selection box of what would be having the biggest impact on the direction of oil prices through the fourth quarter. And we had still in that the geopolitical risk in the Middle East as well as China demand. And look, it's very evenly split. I think if we ask the same question today, the OPEC supply policy might have a bigger weighting because geopolitical risk seems to be off the table for the time being in the Middle East, and perhaps was never really on the table as the oil markets, and as you indicated earlier, the premium that we saw build on the back of the recent tensions was fairly minimal for what was potentially at stake. But my question to you then, Adi, with bringing what seems to me OPEC supply, we've got very clear from Clyde about where China's at and sort of reaffirming what's been a narrative all year, geopolitical tensions back off the table. So the big question now really is what's OPEC going to do about it? And they're currently planning to raise oil supply in 6 weeks' time. So my question to you, Adi, is how does their decision look now? Do you expect them, should they continue with that plan to increase in 6 weeks? What impact does that have for the market?
That's the $50 million question, Sean. It's OPEC is in a very, very difficult position. They've got a brave face on, but the biggest problem for OPEC is lack of demand. And the fact that their current policy is short-term revenue maximization, which essentially longer term is a terrible policy because it's just speeding up the process of transition away from oil. Now, when you have the situation in the Middle East like we have right now, and when you realize how vulnerable the oil consumers are to any potential escalation in the Middle East, and now just going back to Clyde's point, China is the obvious one. When you're importing almost 11.5 million barrels of oil a day, you realize how sensitive and how vulnerable you are to any supply disruptions from the Middle East. So no wonder China is throwing a kitchen sink at solving the problem and moving away from oil. We're going to EVs, going to LNG, compressed gas, and so on and so forth.
And
so
coal.
Coal as well. It's a strategy. They're not. I'm pretty sure they're
which
not
is what gives them their EV electricity power, right? I mean,
absolutely. But that leaves OPEC in a very difficult situation. Essentially, if you look at the supply-demand figures that Clyde mentioned early on, that we've all seen for the last few days, and IEA numbers are coming out this week, you realize that pretty much all the additional demand that's expected next year can easily be covered from the Americas. Talking, United States, talking about Guyana and Canada, Brazil. So they can supply that oil. So if OPEC want to, keep the prices up, you'll just see non-OPEC supply going higher and higher. Now, what we saw prior to the Israeli invasion, pretty much everyone around them, what we saw prior to that, we saw weakness, we saw fundamentals more pointing towards 5.0 than 8.0 price. And there was a lot of talk, and this is a very sensitive word that everyone should actually keep in mind, is market share. 2 words, actually, market share. I think there was more.
We consider them as one word, Adi. We're just geeks,
We're geeks, absolutely. It's just one thing to us.
Share,
it's just one price.
Word.
But market share is something we heard in 1986, and anyone who lived through 1986 will remember it forever. As soon as OPEC start talking about market share, you're talking about a price war. Now, price wars are very, very costly. And we're talking about just one country here, really, Saudi Arabia. They're producing about 3 million barrels less than they can. They've been single-handedly supporting this market. Single-handedly. Nobody else did anything. OPEC Plus, the plus bit is a joke. They had a bit of a support from the other core OPEC members. So if Saudi Arabia says enough is enough, the only option they have, the only whip they have, is basically to supply all the oil they can and flood the market, in which case we're probably talking about $30, $40 a barrel if that happens. And I think the probability of that increases over time, assuming no escalation of the war in the Middle East, purely on fundamental basis. Because as said early on, I think next year easily we're going to have 1.5 million barrels a day of excess supply. And going back to this year, that was kind of looked reasonably balanced. As Clyde said, China has been buying about 1 million barrels a day into their strategic petroleum reserves of cheap oil. And they're fairly full at the moment. So fundamentals are not looking great at all.
And it's not given that, I suppose, a time to be moving ahead with supply increases unless you would have this wider strategy of, as was reported in the FT some weeks ago, some kind of a market share gambit. Osama, meanwhile, back at the ranch of Pakistan and other Asian countries trying to keep the lights on and meet their obligations, Pakistan has finally done a deal with the IMF. Can you tell us a little bit about that and what it means for Pakistan?
Well, surely Pakistan recently was able to successfully negotiate a $7 billion bailout package from IMF. We've been speaking from quite a while now, Sean, and you remember me saying that this is one of the key factors and key decisive element for the current government in its bid to successfully navigate our path towards prosperity. But once again, looking at it from the shorter run, it is good. It will help us manage our finances. We know that Pakistan was going through one of the worst financial economic crises of its history, like any other developing country at the moment, I would like to add. But moving forward or in the future, looking at it from a longer term perspective, I do not believe that these bailout packages, and we have had 24 of them so far, is the solution. And I speak for, I think, for all the developing world, because we tend to face a similar set of problems. The solution is always from within. I've always spoken about creating pull factors rather than international agencies or IFIs, international financial institutions, pushing in billions of dollars that essentially do nothing. I mean, we don't even know if they are being allocated at the right place. So I think we need to turn towards, the market creating innovations.
Well, on that point, I mean, there's certainly the effectiveness of IMF bailouts have been debated for decades. But I wanted to get behind it a little bit from your perspective on the fact that, China has been a very close ally to Pakistan. It has been seen as the kind of financial engine that might help get Pakistan back on its feet, etc. Belt Road Initiative, at Gawar port development, so many different examples. Now the IMF, which is typically more a G7 kind of looking organization rather than China, what does that tell us, or does it tell us anything that it's sort of more of a G7 IMF bailout than a China putting dollars on the table in Pakistan?
Well, that's a really interesting perspective. Actually, Pakistan, it means what it actually tells us is that Pakistan will face quite a difficult diplomatic path to navigate in the future, because this has happened in the past as well, that IMF categorically asked Pakistan to not to use the money given by them by IMF to pay back Chinese loans. But as you said, and I rightly said, and I believe that China is, I believe, one of the only countries in the world that provide a lot of support to Pakistan. And I personally look up to that country in terms of our economic development. We've discussed Belt and Road Initiative, one of its flagship projects, CPEC. We have completed 36 projects so far, $25.2 billion. That was the first phase. The second phase is starting. Chinese premier was here. The SCO summit was being held. I mean, it is being held actually today as well. That speaks to Pakistan's role, that it is still relevant in the region, either in a positive or in a negative way, but it is relevant and it has potential. And Pakistan moving forward cannot pick sides at the moment. We have to have a multi-vector foreign policy. And I believe what is happening right now is a manifestation of that.
Let's go to the survey question, and it sort of underpins a lot of the theme of our conversation this morning, and that is Brent crude oil's next sort of direction. So the thesis here is Brent crude oil to return to test $70 a barrel now that Iran's oil infrastructure is off the target list from Israel, as declared overnight by the Israeli Prime Minister. What else is on the target list is a whole other question, obviously, because if indeed Israel does target Iran, then that certainly pushes over a domino that nobody really knows what falls from there. But nonetheless, in this case, oil infrastructure is off the target list. Oil prices have been declining over the last number of sessions. And where we were before the October 1st strike from Iran to Israel, prices were, Brent was down around $71 a barrel. So agree or disagree with this thesis? And Clyde, this is the big question ultimately, and it sort of underpins the outlook that you're indicating in your article and in your commentary this morning. What will China do in the fourth quarter? We've got two possible draws that might see them back in the buyer's box. One is if indeed Brent does return to where it was pre-October 1st, i.e. knocking on the door of 70, up $1, down $1. And also we have the Chinese New Year. So with China's being opportunistic buyers, it's sort of peak demand season across the winter and the holiday season. Your thoughts on where do you think China goes with those two things on the table?
Well, I think it really just has to be a price-driven thing for them. If they see the price start to head below 70 or test those 70 levels, I expect they will import more. But you've got to remember, if they start buying now, mid-October, that oil doesn't get to China until January. So, you might end up with a couple of softish months, although the price for oil arriving now in November was actually quite reasonable, so it might actually be okay. I think the bigger thing is, everyone's still worried about what might happen in the Middle East. But as long as nothing actually happens, then the price is likely to keep testing lower rather than move higher. My main worry is that it's actually in the interest of quite a number of people for there to be a wider conflict in the Middle East. Yes, things can.
Sorry,
You
sorry.
run the
Explain
risk
that.
of calculations. Well, if you actually did have a hit on Iranian refineries, for example, so not their oil infrastructure or their export infrastructure, rather their refineries. That would still kick the crude oil price up very nicely. And as long as everybody could convince the Iranians not to do anything stupid with, attacking the Saudis or the Emiratis or anybody like that, or trying to shut the straits, you could get a nice real kick in the oil price there. There are several people who benefit from that, not least the Saudis and the Emiratis, Donald Trump, perhaps. There's a whole range of people who actually would have a vested interest right now in seeing this conflict expand. Whether they actually have the ability to make that happen remains to be seen. But
well, it is expanding in the last few weeks. There's no doubt about that. In the context of the different independent fires that have been burning in the region, have started to join up, basically thanks to Mr. Netanyahu. But nonetheless, they're escalating. The escalation is underway. There's no doubt about that. Where it goes, where it continues to go, I suppose you're indicating that there might be actors in the dark shadows that see it in their interest to keep that escalation going.
Oh yeah, I mean, if you look at straight politics, it's in Benjamin Netanyahu's interest for Trump to win, because he will calculate that Trump will be a bigger supporter of his current policies and what Israel is doing, and he also will calculate that Trump will go hard against Iran. So for his perspective, that's what he would want. But he has to keep the Biden administration on side at the moment because they're supplying him with all the weapons and defense systems that he needs. So it's a fine calculation. And I imagine there's a lot of people making similar calculations all across the Middle East, trying to work out what will be best for them.
Adi, looking at that, and obviously that election in the US is now only a few weeks away, and it will happen before the OPEC date of raising supply on December 1st. I'm wondering, Adi, from your perspective, what this would mean. You're obviously a close watcher of events in Ukraine, and yourself lived through the tragedies of your own country, Bosnia, having a long war there. Where do you think this goes? Is it simply 1 and 1 is 2, Trump comes back and Putin gets what he wants? What's your own thoughts on the way that may play out, and then it sort of dominoes into the oil markets?
Thank you, Sean. Pretty wide question. Well,
I know.
It's
a kind of if Trump wins question, what impact does it have? I mean, we know it, as Clyde just said, it's likely to put the screws on Iran. What does it do in the conflict in Europe?
Yeah, well, the Trump election, I think, would be a disaster on so many levels that I think the oil price would probably come at the bottom of my list of concerns. I think it would be a disaster.
I mean, on an oil flow point of view, Russia's getting all the oil it wants. Yeah.
Yeah, I'll come back to that. I think it would be a disaster for the US. For Europe, it would definitely be bad news, because clearly he does not particularly care about NATO, doesn't particularly care about Europe. He's sort of centralist. He just believes in the United States, which is obviously totally wrong, because United States, at the end of the day, is being defended in Europe and elsewhere. So in terms of oil flows, well, certainly he's very, very pro-oil, but that I don't think is very different from Kamala, even though I think, with Kamala's government, we'd probably expect more environmental oversight of the US production, oil and gas production, rather than Trump. But I don't think there's a big difference in that respect. With Trump being in power, I think it'd be very difficult equation in Europe. I think that war would probably be longer than necessary. I think Putin would see sort of blank check there to do whatever he wants, and I think we'd probably see NATO probably being in a very, very difficult position, because Europe would inevitably be would be seeking to find a solution, a European solution for the conflict in NATO solution. I think the conflict would almost certainly, with Trump, the conflict would almost certainly spread elsewhere, and I'm talking about the Western Balkans. Already everything is in place for that. I think Putin's already positioned his chess pieces the way he wants them. And he would do what he is very good at, just spread these smaller conflicts and avoid a larger one, but spread them in a way that sort of suits him. So overall, it would be rather difficult and bad proposition for Europe. In terms of oil, I'm not sure it would make that much difference, to be honest. Trump administration is very oil friendly, but as I said, I think the key to oil market is China and Chinese growth. India is not in a position to take over that mantle anytime soon. And in fact, India is throwing a lot of money at renewables at the moment as well. And I think one bigger picture, since you asked me a conflict question, I think that a conflict, big longer term conflict answer is that this whole situation in the Middle East is just not very good for the oil market at all. I think it puts in a perspective how vulnerable anyone who depends on oil from the Middle East is. And I think the sooner you move to EVs or sort of distributed local energy, clean, ideally energy, the better, because, why do you want
it's a bit like a COVID moment in China where the COVID came and it was like, oh my God, the whole world supply chain is from one place and COVID is disrupted and I can't get my Mercedes made.
Absolutely.
Agree 80% that we will test $70 again. Osama, last word to you. I didn't really get your sort of definitive outlook for the OPEC Plus decision, which on the supply side is sort of critical now to what sort of floor this oil price can hold. Your thoughts on what decision OPEC faces, and do they wait until after the US election, perhaps, before actually making that decision?
Well, I think given where the oil prices will be in terms of geopolitical escalation, I think this was the last time that OPEC Plus sort of, stopped its unwinding of the production cuts. I think now the fiscal pressures would build. We have seen that happening in Saudi Arabia as well. There's a projection of a $21 billion deficit in its budget. And I think looking at these factors, and I've said this before as well, at this podcast, that we might be looking at the possibility of another oil price war, because these cuts cannot go on forever. That's not economically feasible and possible.
Something has to give. Well, we have to give up our seat at the table here with everybody needing to get back to work. Adi Imsirovic from the UK. Thanks, Adi, very much for your insights today. Clyde Russell, as always, awesome. And Osama Rizvi, nobody better, giving us that West Asia perspective. Really appreciate it. Thank you, guys. Have a great day. Take care.
Thank you. Thank you.